Tim, Emily, it is great to have you on. I think this is going to be one of the most exciting conversations because we've never had an investor on the show. So you guys are going to be the first, and I think it's going to be extremely exciting, especially given Wesley Group's previous history and portfolio of companies and each of your individuals' experiences. But I don't want to butcher around your guys' backgrounds, so I'd love for both of you to give a quick background, and we'll jump into a couple of questions.
Great to be on today. Excited to talk a little bit about Wesley Group and what we're seeing from our vantage point at our firm. A little bit on me. I'm a principal at the Wesley Group. I have been working in energy and climate for the last decade. Started my career working in the Obama administration, worked for Secretary Moniz, worked as the chief of staff at the Advanced Research Projects Agency for Energy, which is sort of like a DARPA for energy, funding energy startups and research. And then was in the Obama White House helping run energy and climate initiatives. I then moved out to San Francisco and I was helping run a seed fund called Powerhouse, an incubator in Oakland, and then joined up at the Wesley Group about 2 years ago.
Okay, so small world. Powerhouse, I'm very familiar with them. So that's awesome.
It is.
And Tim, what about yourself?
Yeah, so my background actually, I studied environmental studies in college, but then actually went into finance and actually worked at a couple of tech startups doing kind of fintech in New York. And then I actually moved to Hong Kong back in 2008, where I launched the business for that company, but then also did a startup trying to do kind of a Bloomberg for China. And so I was really on the operator side, having raised capital. Moody's, the big kind of ratings agency, was our Series A investor. And then really after that experience, I went back to business school wanting to do venture. And the whole point was, can I help other people avoid the mistakes I made? And so I was really lucky and fortunate. I was actually the summer intern at the firm here at the Wesley Group, where I'm now a managing partner of. It's been since 2015, and it's been a blessing to kind of both bring the investor side that I really wanted to do and focus in on, but also do the sustainability kind of energy and mobility investments that we're able to make.
Okay, so you have a very interesting story just from the fact that you went from an intern to now you're the managing partner at Wesley Group. So that's a jump that I'm sure will inspire a lot of aspiring fund managers.
Now, folks ask, well, is there like a path from an internship to a job? I said there is. It's happened. It's happened before.
They're far and few between, but it's
Sure.
impressive to see that kind of a jump. But yeah, so like the core focus of what I'm sure everyone in the audience wants to listen to, and I think both of you can bring really deep insight into, Emily specifically from an energy climate perspective very deeply, and then Tim from you having seen and scaled companies before. We want to focus around growth for today's show. We really want to understand what you guys have seen, given the Wesley Group gets involved with companies at basically the stage where they've gotten some form of product market fit and now they're ready to put the pedal to the metal and really scale. And naturally, that's when either these companies fizzle out, burn out, and crash, or they grow and they become the next big thing. Most notably for everyone, Tesla being one of those portfolio companies. So I'd love to kick it off and just kind of leave it out to you guys on the side of growth. What are the general things that you've seen across your portfolio companies working with each of these founders, and the successful ones? What are those key indicators that you've typically seen in your time at Wesley that have led you to believe that, hey, these are the core foundational building blocks of being able to actually grow a company from that Series A stage, and more specifically, moving into climate, which, Emily, I'm sure you'll be able to give much more insight onto as well.
Sure. Happy to start with some of it. I think, from a high level, we're obviously always trying to invest, post-revenue, right? The company's already shown some product market fit, like you've said. I think from our perspective, we're also trying to understand, do they have a sales cycle that's repeatable, right? A sales process that's repeatable and scalable. Those are a lot of the core items that we're looking for, right? Especially when you invest the Series A and B, you're starting to look at, sales metrics, lifetime value of a customer, your customer acquisition costs. These are the things we really expect, the founding and leadership team to have a good grasp and understanding of, and we really want to see repeatability there. Those are the key kind of things that at least I look for when we talk to founders.
So on that kind of repeatability front, is it more of, okay, if my customer acquisition cost is lower than the lifetime value in this case, regardless of the type of company you invest in, is it very much a simple idea of, if I give $10 million and we can acquire customers at $10, but they net us 100, it's just going to scale with that kind of capital being flowed just linearly, though it's never like that? Right. How are you thinking about it in more depth? Like, what is it about a company? Because I'm sure there's plenty of companies you've seen which have those good metrics that end up fizzling out and burning. What are those things that you've noticed?
Yeah, I think, from a high level standpoint, it's not only the LTV to CAC ratio. I think we're also looking for average contract size, right? And we're trying to see, is this a $10,000 recurring contract, or is this a multi-hundred, $200,000, $500,000 contract? I think we're also looking at that pace and win rate, right? Close rate of customers. I think what you're asking for and thinking about is that linear. We'd like to see some linear growth, but in all honesty, we're trying to look for, extremely quick growth, right? We're trying to look for that hockey stick all the time and exponential growth. And so, those are harder to find, and we're trying to time it, right? So our job is really to identify that inflection point. When are they going from 10 customers to 30 in a year, or, 30 to 100 customers in a year? And those are the things that we're always trying to identify. When we look at the pipeline, we're looking at pipeline coverage. If you're projecting you have 5 million of revenues this year, do you have at least 15, 20, 25 million in pipeline to justify that projection? So those are a lot of the key metrics that we're looking at as well.
So in terms of like pipeline, I'll jump right to you. But in terms of like pipeline, is that very much on the side of just generally, if it's a big padded pipeline, you have a high close rate? Are there certain things that the founders are doing, or these companies and this leadership is doing, that makes it stand out when you're deciding between two separate companies? Is there like a distinction there?
Go ahead, Emily.
Yeah, and I think that gets beyond there's metrics, and we invest in a lot of software, so there's certainly, best in class SaaS metrics that a lot of investors will look at. But, beyond that, it's also trying to get to know teams and understand their ability to execute, right? And so Tim is sort of hitting on a point, which is, as you get from the Series A to the B, have you invested, or are you capable of building a scalable operations? And so something that we see a lot of companies struggle or do well, which can really determine their success, is building a global sales team with strong sales talent, with best-in-class sales efficiency that certainly can hit on these metrics. Also building a sales ops team and a layer of operations, whether it's HR, whether it's product, that can, where you start taking responsibilities from the founders and the CEO and some of those initial team members, and building a middle layer of strong talent that can own those functions and and add a robustness to the company.
It almost feels like recruiting is a key element to actually justifying if that scale is possible.
100%, yeah. I mean,
I think for sure.
From the Series A to Series B, right? We're dealing with this with several of our companies where, traditionally you're going to see an entrepreneur say, hey, we're going to go from 1 to 10 million. And more likely than not, you never hit your projections. And so when going back to your question of, if you're looking at two companies, what are you going to look at? It's who's predicting their revenues and sales forecast and who's hitting their marks, right? And the closer you are to your projection, obviously that's where we are going to probably put our dollars to work. And that's very difficult to do, right? And you have to get a solid team around sales forecasting, sales pipeline, but also closing deals, right? And I think that's very important. It's not just the CEO, it's not the COO or even VP of sales. Sometimes it's your kind of card-carrying quota, salespeople. Are they executing at a higher level and predicting that ability to close? I think that's really important for us.
That's actually
and it's a funny kind of misnomer in venture, which is like, I think a lot of entrepreneurs go out and when they're pitching for money, they think they just have to, create a case to that hockey stick growth. And certainly you do have to make the case for a high growth venture-like company. That being said, I think some entrepreneurs run into an issue of picking arbitrary forecasts, and then, when someone invests, you have to meet those forecasts, right? So there's a difference. I think most investors actually want a realistic expectation of growth, understanding what it takes to start to enable venture growth, as opposed to unrealistic expectations that you're never going to meet.
So you mean I can't scale my company from $1 million to $20 million in revenue in a year?
Well, some people do that, but it's few and far between.
It's possible.
Yeah,
it's possible. It's just not likely.
So I need to build a plan around that. But I guess then digging into like a climate front, because like I always run into this disconnect, right? Because you see SaaS companies or just software companies in general, forget SaaS, growth is ridiculous, or at least on paper it looks ridiculous with the amount of customers that they acquire, and their revenues just skyrocket. Naturally, we're on a climate-focused podcast, so we're going to kind of switch that kind of focus there. What differences do you see? Because typically with climate, there is usually some kind of hardware involved, and the funny thing about like AI, at least from my experience, is it's more services-oriented and tailoring than a traditional SaaS company as well. So even in that bucket where you have climate AI companies and you have hardware-focused companies, how does that framework suddenly change when you guys are approaching making that investment? Because I know you guys just announced your, I guess, fifth fund, and it's fully focused on climate?
Yeah, we announced our fourth venture fund. It's a $300 million fund. We've been around since 2007, so for us, we've been there kind of since Cleantech 1.0, and to kind of get to grow and actually get a larger fund this time around to kind of tackle climate has been a great kind of thing for us and the team.
And we focused a little bit, just to clarify too, on what we focus on. We focus on energy, mobility, industrial technology, buildings, and cybersecurity. So climate, decarbonization, and sustainability is a huge part of that strategy. It's in the DNA of the firm. We're also looking a little broader at horizontal enterprise SaaS, and sort of other business models within any of those sectors are of interest for us.
So almost all difficult to scale industries.
Yeah, essentially, yeah, longer sales cycles, right? I think one of the key things that we're also trying to tackle, though, is, it's not necessarily the solar panel, right? That's going to keep on going down in price, hopefully, without the semiconductor issues and chip shortages. But our goals are trying to find platforms that reduce friction in deployment of all these assets, right? So EV chargers, EVs themselves, battery storage, right? If we can identify companies that get these assets in people's homes, office buildings, wherever they may be, we want to invest in those companies. So that could be a fintech opportunity, right? It could be around financing, right? Because right now these are very expensive to get in people's homes or office buildings, but if I can make this no money down, very small payments, I've just enabled the vast long tail of people in this country, this world, to access clean energy, right? So those are the types of things we're trying to identify as well.
Okay.
Yeah, and I think that's a great distinction, because you kind of rightfully point out that climate companies, especially ones that are going after decarbonizing really difficult things like industrial environments, are not your traditional venture investment. And I think as a firm, we have decided to focus more on those enabling technologies, business models in the values and services and software and digitization of climate and these industries we invest in, as opposed to investing in materials technology or CCUS or hydrogen or, kind of name your category. And there's some funds out there that are funding that stuff, and they've created a model that's probably more appropriate in timeframes that are more appropriate for those types of companies, which is much needed, to meet our climate goals.
So, I mean, to loop it back to that scalability question, especially your background, Emily, having basically worked energy climate, I'd say for a decent part of it, and having the background of venture makes you a very interesting person to ask this question to. How does the scaling function, or what are the growth approaches that you see in climate or in general these hard to scale, as Tim mentioned, longer sales cycle companies that really stick out to you, that differ from the traditional kind of knowledge base that's put out there from software engineers and SaaS founders that have made it big?
Yeah, so I mean, I think there's two different growth obstacles depending on the company. If you're a hardware company, obviously your growth obstacle is that you spend, sometimes 6 to 10 years just getting the product to be commercially ready, right? So it's a very different growth challenge. And for those types of founders, we are, we're not as likely to invest in those companies, but a huge part of de-risking those companies and enabling scalable growth is just getting to the point of manufacturing at scale, right? And a lot of that is just pure execution, but also the capacity to raise money and de-risk a business model in a company by being able to have, in some cases, hundreds of millions of dollars to get to that point, right? So that's kind of that category. I think on the software side, a lot of the things we've already talked about, which is there are actually business models that are direct to consumer or going after the middle market that don't run into some of these scalability issues as much, because the sales cycles are shorter, billing and payments are easier, etc. But for companies that are focused on selling like into the industries we invest in, which are large enterprises, in a way they have to do a lot of work to create a not bespoke product, but a really standard product and offering. Find a way to quicken the cycle for billing and payments, getting through procurement and contracting. And third, they just need giant pipeline coverage, which Tim alluded to, which is like you're going to need far more pipeline coverage to meet those venture growth metrics if your sales cycles are longer and you're having to work to get contracts through large enterprises, which are always a bit slower.
Okay, so then I see like two big things here, just to like kind of repeat that back to myself here. If you're a hard tech founder in the climate space broadly, the biggest takeaway is if that founder is able to justify raising the hundreds of millions required to get the price point down so that you can actually fulfill that. I imagine there's an interesting Tesla story there probably also, and with the other portfolio companies you guys have as well, I'm sure there's some interesting tidbits. Tim, since you've been along for a while, could you dive into that, and then we'll jump back over to the AI and services side?
Yeah, happy to. I think the standing joke is that yes, we are focused on climate and capital efficient models, but one of our biggest winners, that's a multi-trillion-dollar business, is Tesla, and so that's a very hardware, very capital intense, and lower gross margin business. But I would say probably 3 points that we look for in these businesses. One is, are you still getting better than average gross margins compared to the rest of the industry? And if you look at Tesla, compared to other OEMs out there, they are getting by far and away better gross margins day in and day out, right? So if you're looking at kind of best in class, they are beating out all the other OEMs in the world. And so that helps stake their claim. Number one. Number two, I would say, do you have a product that is far and away better than anything else in the market? And so obviously we're kind of biased. We think Tesla is great in that regard. Another case and example is Luminar. So Luminar, you may not think is a climate, enabled company, but really they're enabling autonomy.
Right.
And we kind of assume all autonomous vehicles are going to be electric. So we really wanted to hone in on that company. And while we looked at, hundreds of different LiDAR companies, by far and away, they had the best product out there. And so if you see them out today, not that they're public, they have the highest market cap of any other, competitor in the market, and they're winning, series production contracts. And then third, as Emily mentioned, really is that capital raising. So, with Tesla, it wasn't always easy. I think people now know, they had a couple of moments where they were on the edge of, being done for. And luckily, you needed some serious capital, both strategic capital, but also government funding to really get that company over the line. And, with Luminar, we were able to raise a very strong Series A back in 2019 when it was needed. And so I think it's on to the CEO and the co-founding team to be able to raise capital to not only keep your sales momentum going, but to also prove out the manufacturing and your BOM costs, that it can continue to go down. right? And there are some data points around that, especially with Luminar, from the first, LiDAR sensors down to what you will see in vehicles starting later this year and next year. There's a huge cost down curve when it comes to those sensors.
That's actually really fascinating. So the two things that I've never heard of or typically don't hear about is the gross margin analysis point for hardware companies. And then the third one, which I think is talked about far and few between, is looking at other non-traditional, at this point, anything not venture is considered non-traditional, it feels like. And it's being able to raise from grant funding sources, government funding, maybe even finding customer funding avenues and such. How often did you see that with the hardware companies in your guys' portfolio, where they had to tap into alternative sources of capital to get to that stage where, I'm going to just say 100 million is the arbitrary number that makes it, but that's for conversation.
Well, I think the story that's well told is, I think Tim was referring to Tesla, which is that Tesla had a loan guarantee through the Department of Energy, which was really critical in support of the company at an inflection point that really mattered. I would say it's a mixed bag. I don't know that we're saying every single hardware company needs government support, but I think, especially having worked in the government and seeing the role they play, that non-dilutive funding can be a great complement to raising private funding. But I think, your point is so well taken, which is there's venture capital, which is one aspect of funding a company, and there's also increasingly other vehicles for financing, especially on the project finance and debt side, that we're seeing utilized more often for companies with an infrastructure or project focus. And I think that's a great opportunity for a lot of climate companies.
Okay.
Yeah, I think, if you think about it historically, back in 2006, 7, 8, really venture investors the burden was on them to be able to fund all these different climate opportunities, right? From batteries to vehicles to whatever, you name it. I think that pool of capital has changed drastically over the past 15 years, where now you're getting a lot of the big mutual funds, a lot of the big banks. Everyone's coming in. They know that this is profitable. They know that the cost down curves are there. They know that there is strong demand now in the market. That also wasn't really available back 15 years ago. Now there's huge demand for EVs, a lot of demand for solar and batteries. And so that has really changed the dynamics of funding when it comes to climate companies.
And that, I think, kind of carries over just because, you see, because, even in terms of, alternative funding beyond debt, it almost seems like there's a consolidation kind of effort going on in the climate space, at least in energy specifically. You see the formation of Uplight, which I don't remember how many companies formed Uplight, but it was just a bunch. And I think one of those companies was even a portfolio company. Tim, I think Correct. You led that deal. Yeah. Is there also a twist there where companies, after raising their Series A, realize that the way we hit those hockey stick growth curves is by joining forces and turning into behemoths 2.0?
Yeah, I think so. Yeah, so our original investment was in a company called Simple Energy, which was based in Boulder, Colorado. And so, it was certainly one of these instances where we knew they had something special they were doing and providing customer engagement for utilities, right? And so one of the key things that we've noted over the time is that, utilities and customers in general like to buy from a company that has multiple products. And so this was a really good case in point where doing a roll-up strategy via private equity funds really enabled this company, Uplight, to really provide multiple products and services to utilities in one-stop shop. And I think that was a really good avenue for that company in that roll-up. We're seeing this happen in multiple industries, so not just in energy. We're seeing this across water. We're seeing this across other, sectors as well. But it really was 1 + 1 = 3. And it was a really good case study in seeing that happen here.
And is that something you guys think about at the Series A stage, saying hey, a sales ops team is probably not the best play here for them to hit those hockey stick metrics, but if they go partner with my friend founder over here and this becomes another product in their portfolio or a feature set of their offering, then those revenue metrics become suddenly realistic. Is that something you guys are actively thinking about alongside the founder, or do you love it when, founders may come to you saying like, here are the 3 different options that we have available to us to get to those revenue metrics that we're talking about? Like, how do you guys typically open that conversation? Because it almost feels like every pitch deck you guys probably see typically just says, here's how we're going to take the millions you're giving us now, we're going to hire a big team and scale it to the moon.
Yeah, I think what you're alluding to is partnership strategy. So there's just, like sheer force around a sales operations, and then there's other channels for building revenue. I think we certainly work side by side with our portfolio companies on defining partnership strategies, different interesting channels for their sales teams, and getting creative without unintentionally kind of hemorrhaging the business in another way because you partner with someone and then take revenue from another part of your business, which we've seen some founders pursue. So that's definitely where we like to help. And I think we really pride ourselves on rolling our sleeves up and being a part of these business development and sales teams and creating a lot of business and commercial opportunities. Our fund has strategically brought in 20 of the world's largest energy and mobility and industrial companies into the fund. So big utilities like Duke, AEP, Dominion, mobility companies like Audi, Bridgestone, Alaska Airlines, 2 large specialty vehicle companies, and then industrials like ABB. And so we are opening these doors to these contracts, but then of course, in addition to that, advising around channel and partnership strategy and other ways to drive revenue growth.
Okay, so then I think that's a perfect segue, because I imagine when you start to flip over to the software side with AI companies, and it seems like almost there's this like emerging, crypto's no longer, I would consider emerging at this point, people know of it, but this kind of marriage between crypto companies and software companies focused on climate, or AI companies that now suddenly have blockchain in them. Usually the joke is it's just to raise capital, but I'm sure there's more depth there. Is there something that you could share from your experience, Emily, given that's a area of interest to you, that tells you, hey, this is why climate, crypto, or these SaaS companies are really exciting at this day and age and need the capital to scale, and what makes these things unique as it relates to the hardware approach, which Tim outlined, those 3 areas of gross margin, better product, and unique fundraising strategies?
Yeah, we always hear a lot of pitches with buzzwords, which is kind of what you're talking about, whether it's machine learning, AI, blockchain. And so part of our job is to discern what is actually going on and what is real and what is a good use case for those technologies. And there's a lot of interesting companies that are popping up in this climate Web3 space, I think is now how people are coining that area of interest. And, some are, maybe further out, which are thinking about how you better transact carbon markets using blockchain technologies or cryptocurrency. We have actually made an investment in this sort of Web3 space, in what we think is a nearer term market opportunity. It's in a company called Circular, based in London. They're focused on providing supply chain traceability from the mine all the way through manufacturing of a product for industrials, with a big emphasis around battery metals and commodities that are driving the EV and electric revolutions. So they're doing traceability for copper, nickel, lithium, cobalt, and then they're also layering on the ability to do scope 1, 2, and 3 emissions accounting for those supply chains, and the reporting capacity to report on, especially those scope 3 emissions, which are really hard to narrow in on. So that is our investment in that space as of now. Because they're using blockchain as one in an entire stack of technologies to do the verification and certification. But I think some of those companies are super interesting. We're excited to continue evaluating that space. But the real question there is just, what are near-term use cases for those types of technologies, and what are use cases that might be a further time horizon out in terms of market readiness?
Got it. So that's actually really interesting because it's a clever use for blockchain in terms of transparency. I mean, I think the thing that I get really fascinated by in that kind of front is I imagine a lot of enterprises are not ready or prepared to really adopt these kind of frontier solutions. Even AI kind of feels like something that is still difficult to push through the enterprise. So like what are the different kind of strategies or foundational building blocks you see founders doing at that series A or that growth level that differ from hardware companies traditionally with Web3 climate businesses or just climate AI type companies and the like?
Yeah, it's a great point. One thing we've seen is that for companies, a lot of companies like that, there's this educational process, and that can, it's not to say there are not willing buyers, but they may take a longer time and lengthen your sales cycle. And so we've seen some interesting strategies there so that companies don't have to take on that educational period. A few companies have worked with consulting firms or channel partners to basically do that education on their behalf. So if they get inbounds for companies that want to adopt a solution but are not quite ready, they don't know where to start, they will work with those partners to offload some of those services, and then those customers often return to once they're ready and willing to buy. So that's something interesting we've seen. But Tim, what other thoughts do you have?
Yeah, I think, from what we've seen, both I'm speaking to the AI kind of world of companies, but also kind of blockchain related. I think a lot of it's going to be that use case. It's going to be that POC process. And it's about showing value as soon as a few days, right? If it takes 6 months to provide value and do a case study and run the analytics, you've taken too long for a customer. And so one of the unique things we saw in one of our other companies called Optimal Dynamics, they help with middle mile trucking logistics, right? So we've heard nothing but supply chain logistics the last few years now because of COVID. And you're talking about a very sleepy industry that wasn't really ready to change or adopt AI. But when you've got a huge constraint with a shortage of drivers and you've got supply chain issues, well, they're willing to pay, but you've got to show me real value in a number of days. And that's what this company was able to do. They had POCs that ran for 30 days, which is still relatively quick. But within a few months, they were able to narrow that down to about a week. And if you're able to kind of provide value at a high level to customers, you're going to see that kind of flywheel go faster. And I think that's what we really want to see across a lot of our companies is how can you provide value sooner and get faster to market for these companies? And then that means faster implementation times at the end of the day, right? I think the knock on a lot of these companies has been you sign a contract, but it takes you 3, 6, 12 months to fully integrate and get paid. And so faster time to market is really the key here for a lot of growth of these companies.
That's okay. So that's really interesting because you always hear that with at least seed stage companies, you run into that challenge where POC is, or any kind of innovation department you work with corporates, you're going to join pilot hell, and your company stands a good chance of dying at that stage. But it really seems like that actually is because it's very difficult to sometimes get corporates to commit to do follow-on projects and contracts with you and scale it within their organization unless that POC goes really well. Have you guys seen certain methods that have made these modern-day software companies or enterprise software companies that are serving these antiquated industries, we'll put it that way, that have made it possible for them to deliver value? And are there any studies or specific experiences you guys have seen amongst your portfolio where you could highlight a storyline going hey, here's how company blah actually shortened their POC process to show value quicker, and that's what was the unlock for them? Because I think that could be a really good learning lesson.
Sure, I'll just give you that one example of Optimal Dynamics. Here was a company that was doing 30-day POCs, and I think the aha was probably one of two things. One was, how can I streamline the data needed from the client side? That's usually half the battle, right? Which is, hey, company X, you got to give me that data first, then I got to run it in my platform to be able to give you results. And so if I can streamline that process of data ingestion, you've just kind of cut the time in half, hopefully. So I think that's one. And then number two is creating a product, that may be extremely detailed for the customer, but at the same time, you've just got to show who your audience is. Let's say the C-suite or the purchasing person at the company. Here's the value that I can provide you very quickly, strategic planning. And that's one of the things they did, right? They showed you from a very high level strategic perspective, where can you save a lot of money and a lot of time. And so, sometimes it's part of that demo and part of that POC that really enables a customer to kind of have that aha moment.
Okay, so that because of the frequency you can now do these POCs, suddenly your pipeline can grow significantly bigger. In turn, you can actually drive exponential growth as opposed to needing to scale the number of humans that are going out there and doing these sales cycles. Got it.
Correct.
Awesome.
Yep.
Well, I think that's a lot to digest for people, just in general in terms of like growth. So I'd like to kind of flip it back and take it a little bit more high level and understand a little bit more about what you guys are looking for with this new fund, your fourth fund, that has climate as part of it as well. What are those kind of things that you would like to plug? I'd love to give you guys the air, both of you, Tim and Emily, and you can put in storylines of things that you would like to see, and the floor is basically yours to share your opinions and what you'd like to selflessly promote here.
Yeah, so I mean, as we mentioned, in this $300 million fund, we're writing $5 to $15 million checks, mostly in Series A and B companies. And we're focused on energy, mobility, industrial technology, buildings, and cybersecurity. So anything in those verticals is of interest, or any horizontal solutions that have a high relevance in those verticals is of interest. So that's pretty broad. When it comes to climate solutions, especially enabling climate solutions, some areas that we're interested, excited about, if you're starting a company or you know of anyone, we're interested in climate resilience and have looked at quite a bit in wildfire resilience, vegetation management, insurance, etc. We're really interested in supply chain and logistics. We're interested in financing solutions, whether it's for behind the meter, in front of the meter, renewable energy, or PPA efficiencies, anything around financing to enable the deployment of renewables. We're interested in next generation of electrification. So what are interesting business models that go beyond electrifying passenger vehicles, but medium and heavy duty trucking, shipping and maritime, or commercial fleets. So those are, I could go on. Those are just a couple areas of interest. But Tim, what else is top of mind for you?
Yeah, I think there's probably a couple other buckets. So one is, as Emily mentioned, we have 22 of the world's larger energy, automotive, water, and industrial companies. And so we're all trying to tackle a lot of the same issues here around climate. And so if it's a company that, ABB or Audi or Duke Energy can be a customer of, that's another product or service that we will look at as well. And so, we're constantly trying to see how can we enable our clients and all our LPs to solve big issues around, let's say, EV fleet management, right? We know there's a huge coming wave of EVs in this market. Well, you got to think about the grid. You got to think about where and when these cars will charge. And some of these real problems are what our customers are trying to tackle. And so that means we're looking at EV fleet companies. We're looking at servicing companies. That's across the board of what we're always looking for. And then I think we're also looking global, right? So we're not just looking here in Silicon Valley or the Bay Area. We've got portfolio companies in Pittsburgh, we've got companies in Germany, in France, and so we want to continue to look globally because we think, especially with COVID, entrepreneurs are everywhere. And so from that perspective, we cast a very wide net and want to enable anyone to really come and seek funding from us.
That's awesome. I guess my last one with two-part question is, what would you say is the biggest reason a founder should reach out to you guys to have Wesley Group on your guys' cap table? And now that they're fully convinced, how would they best reach out to see if Wesley would be interested in their company?
I think, one of the things we like to kind of pride ourselves, as Emily mentioned, was that, we really want to help our customers roll up our sleeves and be a natural extension of your sales team, right? And so I think when Steve founded the firm, he knew that there were already plenty of venture funds that have managing partners with PhDs who can help you on the technology side of things. And I think for us, if you are an entrepreneur or a co-founding team that is seeking kind of sales and customer development work or kind of regulatory help, I think we are the fund to help you do that, right? We really want to help our customers and our investments really connect together. And I think it's important for us to be your natural extension of your sales team. So that's what you're looking for. You're looking for revenue in your company.
Awesome.
Come
And
to
Emily, how would they best pitch you?
Yeah, if you want to hear more about the firm or meet someone from the investment team, I think our emails are pretty accessible, so you can just shoot any of us an email. But also we have a contact button on our website that you can email that is sort of a general email that goes into our inbox, and we will make sure to get back to you, and would love to hear more.
Awesome. Well, if neither of you guys have anything else to add, I'm going to let you guys get back to finding the next big company, especially in the climate space. And I can't thank you enough for sharing your guys' experiences and knowledge on today's show. And hopefully we'll be able to bring you guys back after you guys have a couple of successful winners out of your next fund.
You got it.
Awesome.
Thanks so much for having me.
Thank you very much.
Take care.
You bet.